Thanks very much to Innovate Finance for inviting me to speak today. And it does feel quite apposite that I'm following on from the end of that panel. Money and payments are fundamental to the Bank of England's role to maintain monetary and financial stability, and these have been no stranger to technical innovation over many centuries. But more radical change seems to be ahead of us now. Today, what I wanted briefly to do was to set out how the Bank of England is helping to ensure we harness the benefits of these advances and ensure they're safe. I'll discuss how we're increasingly focusing on innovation in wholesale payments and the importance of payments innovation by banks. And we'll publish a discussion paper on these areas in the summer as a complement to our existing work that I'm sure you're familiar with on stablecoin regulation and retail central bank digital currency. Facebook's proposal of a Libra stablecoin 5 years ago reminded us that technological innovation in money and payments is far from over. Indeed, technologies loosely grouped under the heading of tokenization, distributed ledger technology, and the potential for atomic settlement and programmability, as pioneered in crypto asset markets, have got the potential significantly to enhance the functionality of real-world retail and wholesale payments. I like to think of money and payments as trains and rails. Money's the train, and the payment system is the rail by which it travels from payer to payee. And the Bank of England is a provider and a regulator of both. First, we provide trains and rails of our own. We issue our own money, banknotes, and central bank reserves, and we run the UK's real-time gross settlement infrastructure, which transfers reserves between financial institutions. And then second, we regulate the trains and the rails provided by the private sector, money issued by commercial banks and interbank payment systems. And technological innovation means we need to look ahead to identify what changes may be needed in these roles as we look ahead. Indeed, while the Libra DM proposal appears to have come to naught, the possibility of stablecoins becoming used at systemic scale for retail payments remains. And that's why in November, the bank published a discussion paper proposing a regulatory regime for such stablecoins, while the FCA proposed a regime for stablecoins more broadly. The bank's proposals aim to ensure that the new train, the stablecoin, and the new rails, the stablecoin payment system, are as safe as those currently used for retail payments in commercial bank money. It'll be impossible to provide resolution and deposit insurance style protections for stablecoins, since there simply isn't a broader industry amongst which to share the costs. So that means tighter requirements elsewhere. And we've proposed that stablecoins used at systemic scale for payments be backed by 100% by unremunerated central bank deposits. Now that means revenues for stablecoin issuers can't come from their backing assets, but they can come from the provision of the payment rails themselves or through ancillary services. Some respondents to our discussion paper said these requirements would challenge stablecoin issuers' business models, potentially barring the use of stablecoins at systemic scale. And we'll, of course, consider all of the feedback received and will consult further on a draft rulebook. But my fundamental point is that business models wanting to offer a systemic means of payment and earn revenues from maturity and liquidity transformation should be regulated as banks. At the same time as considering how to regulate new tokenized money, we're also exploring whether to provide such money ourselves. We consulted with the Treasury last year on a retail central bank digital currency, a digital pound, And we published in January our response to the over 50,000 responses we received. Many people raised important concerns around ensuring privacy and control of the digital pound and the payments made. In response, the government has committed to introducing primary legislation to Parliament before a digital pound could be launched, which would guarantee this, and it would consult further before doing so. But let me emphasize, we will issue banknotes for as long as people wish to use them too. I also want to emphasize that we've not taken a decision on whether or not to issue a digital pound, but we do think preparatory work is prudent, so the option to issue is available if needed. Key inputs to our decision in 2 years or so will be the innovation we see in other forms of retail money, especially commercial bank money, as well as how our own wholesale payments infrastructure might evolve in support. And let me cover both those in the rest of these remarks, starting with our work supporting innovation in wholesale payments and settlement, an area on which we are increasingly focused. This month, the bank, together with the FCA, consulted on our digital securities sandbox. It'll enable the private sector to set up real-world trading venues and settlement systems using new technologies such as DLT, and we plan to open this to applications this summer. Now, these won't merely be prototypes or experiments, they'll be live in the financial system. So this is an exciting opportunity to get practical insights into these technologies' potential benefits, though we'll place limits on activity to ensure it takes place safely. Now, as securities are transferred from buyers to sellers, so money needs to be transferred the other way. Our starting point is that there are financial stability benefits from settling wholesale transactions in central bank money, and that there is a tail risk from too much wholesale settlement taking place in privately issued money. We've made headway in modernising the UK's RTGS system, but tokenised securities transactions in the digital securities sandbox would not currently be able to settle in central bank money right now. So we're increasingly focused on how best our wholesale infrastructure should evolve to support the settlement of tokenised transactions. And broadly, we see three models. First, we have already established a new omnibus account in RTGS, which allows private sector payment systems using DLT to offer settlement in a tokenized representation of central bank money. This allows the private sector to offer a train with the safety of central bank money traveling on privately operated payment rails using these new technologies. Second, the bank is exploring with the industry extending RTGS in order to offer synchronized settlement, where money would move on the traditional centralized RTGS ledger at the same time as tokenized securities or digital currencies move on other distributed ledgers. Our train, our rails, but coordinated with a timetable to ensure that these things happen safely. Third, some other central banks are experimenting with going further and tokenizing central bank money themselves, so-called wholesale CBDCs. And the question we are keen to consider is how these different models for central bank infrastructure compare, and whether there are important differences in the payments use cases they can support. Now, I'll finish on what the coming wave of technology innovation in payments means for commercial bank deposits, which of course support the vast majority of retail payments in the UK at present. As the Governor Andrew Bailey said at Mansion House last year, we do not want the central bank to be left as the only game in town. In addition to our exploratory work on retail CBDC and stablecoins, we want to encourage more thinking and, crucially, action by banks in payments innovation, including tokenized bank deposits. I'm firmly of the view that the technology innovation will hit, indeed is hitting, finance in the way that it has hit other sectors of the economy. It strikes me that for banks as the incumbents, payments innovation is both a first-tier opportunity, given the potential benefits for them and their customers of additional payments functionality, as well as being a first-tier threat, given the risk of disintermediation by new players, and that, in my view, demands urgent action. For the Bank of England's part, we'll support this, not just as a regulator, but as a provider of modernised wholesale infrastructure by which interbank payments ultimately settle. We've just launched Project Agora with the Bank for International Settlements and other central banks and commercial banks globally to test the integration of tokenized bank deposits with tokenized wholesale central bank money. So to conclude, new technologies offer the prospect of enhanced retail and wholesale payments functionality in the UK and across borders. Our immediate focus at the Bank of England following the Libra announcement in 2019 has been on retail payments, regulating stable coins and exploring CBDC. But we're increasingly complementing that with a focus on how we can best support innovation both in wholesale payments and in commercial banks' retail payments offerings. We'll set out our thinking in these areas in a discussion paper this summer, and we look forward then to harnessing the expertise and creativity of all of you people in the room today. Thank you very much.